Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. It's the 11th of July 2023 and here are the top stories for the day. Why is Google attacking CCI? Can India become a wearables powerhouse? Will the FII buying spree continue? And what is the Chandrayaan-3 mission? The rivalry between two US giants, Google and Amazon, is finding echoes in Indian courts now. On July 14th, the Supreme Court will hear the cross pleas of Google and the Competition Commission of India, or CCI. Google, which was slapped with a fine of over 1,300 crore rupees for its alleged anti-competitive practices a few months ago, has accused CCI of protecting Amazon's interest. So what is this allegation about and why is Google attacking the CCI? Debar Gosanyal brings you the report.
Competition Commission of India, or CCI, had imposed a fine of 1,337 crore rupees on Google early this year for allegedly abusing its dominant position in the Android mobile device ecosystem. It had come just months after Google was found guilty of similar charges in Europe, and a fine was also slapped on it by a court there. And just a few months later, the National Company Law Appellate Tribunal, or NCLAT, upheld the CCI penalty on Google. The tribunal held that a number of Google's practices pointed to an abuse of dominance. But the NCLAT set aside 4 of the 10 conditions that the CCI had imposed on Google. It included preventing sideloading of apps and sharing Google's Play Store code with original equipment manufacturers. Now both the Google and the CCI are in the Supreme Court. While Google wants the CCI order to be quashed, the CCI had challenged part of the NCLAT order. In its appeal, Google said, had the tribunal applied the effects test, it would have found that Google's agreements were incapable of causing any anti-competitive effects. During its investigation, the CCI had approached industry players and asked if Google used its dominance. Amazon, which was among them, told the CCI that Google's dominance hindered the growth of its Fire OS. Amazon also appeared before the CCI as witness in July 2022 when the competition watchdog asked industry players, including Amazon, Mozilla, and device manufacturers, during the probe against Google. Amazon had claimed in its submission that it had experienced significant difficulties in finding OEM partners to manufacture smart TVs running its Fire OS due to Google's Android compatibility commitment clause. Amazon had also informed CCI investigators that the creation of Fire OS as a forked Android system required substantial resources, including thousands of employee hours. Google, in its appeal, had targeted Amazon, arguing that the CCI unjustly relied on Amazon's complaint when making its adverse decision against Google, stating that Fire OS had failed commercially on a global scale and was not even launched in India. However, experts believe Google has been aggressive in its appeal against CCI.
You have a tendency to adopt different sets of standards in Europe and different sets of standards in India. So that is the crux of the matter. Google has a tendency, with due respect to them, to be slightly unduly aggressive against the regulator itself. It is not only Amazon. If you look at the order of CCI, there were several others who have similarly contended before CCI. These included, besides Amazon, Mozilla, even Microsoft, including even Alibaba and so on. They were all biggies. So they all said that Google had become dominant. CCI, as a very matured and neutral objective regulator. They have been taking a stand relying on what has been done in other jurisdictions also, including in Europe. So what they have done is absolutely in order, it's correct.
So with Google's counter allegations, what are the implications of inviting third-party submissions in such a case?
In all such cases, and in fact in all cases that the CCI looks at, third-party submissions are relied upon and are central to the investigation. The reason for this is that under the structure of the Competition Act, any person, whether or not they're an aggrieved party, can file that initial information. And if a researcher, as in this case, who filed the information, may not have the same kind of information or input or detail to provide the commission as players in the market. So once the investigation starts, it is the role of the Director General's office to in fact reach out to these third parties and get this input from them, as these third parties are best placed to answer the question, is Google's abuse of dominance impacting the market? And so this case, there's nothing untoward about relying on third-party submissions. It's fairly standard.
However, what is curious in this case is, and that's what has been highlighted by Google, is that it just relied on certain competitors, namely Amazon, while it did not take comments from OEMs like Samsung, Sony, and others who are actually in the same space or developing an Android fork.
Does the CCI's handling of the case send out any negative signals for the larger competition ecosystem in India?
The CCI is very interested and is looking at big tech generally. The government is very interested and has started the process of passing a digital competition law. I don't believe this is the CCI either getting caught between two technology giants or favoring one over the other. The CCI was doing its regulatory duty in reaching out to competitors in the market and potentially interested parties in finding out what the lay of the land is.
Experts believe, therefore, that with the fast-growing tech ecosystem in India, multinational giants like Google will have to understand and eventually accept the larger regulatory atmosphere that regulators like CCI have enforced. On the other hand, given the push for tech innovation and manufacturing in the country, regulators like CCI will also have to make sure that the structures are not too rigid. So the current case is merely a stage in the evolution of India's tech industry ecosystem, they believe.
India's wearables industry too is coming of age, and the country is likely to become the world's largest market for wearables by the end of 2023. It comes at a time when markets like North America and China are going through a difficult phase, and signs of saturation have begun to emerge. But Apple still leads the global wearables market with a 20% market share, followed by South Korea's Samsung and China's Xiaomi. Indian manufacturer Noise is at the fourth spot. With stiff competition at the top, can India become a global wearables powerhouse? Pashur Kumar has the answer.
India's ambition to become a global hub for electronics faces a tough challenge from countries that have been more savvy about taking advantage of free trade agreements and keeping import tariffs low. According to estimates by the India Cellular and Electronics Association, or ICEA, exports by Vietnam, Mexico, and Thailand stood at 9.2 times, 6.3 times, and 3.8 times that of India in 2021. And even if India meets its ambitious FY26 electronics export target, which is pegged between $105 and $130 billion, it will still be far behind Vietnam's, which stood at over $130 billion in 2021. In FY23, India exported electronics worth only $24 billion. Moreover, the ICEA feels that it will be challenging to even reach the government's FY26 target because even if the highest growth rate achieved in 2015 is maintained over the next 3 fiscal years, India's exports will only touch about $90 billion by FY26. However, there is some good news in one segment of the broader electronics ecosystem. According to One Financial Daily, India manufactured wearables like smartwatches and earphones worth almost $970 million in FY23, up from almost nothing in FY22. That's because of the implementation of the Phased Manufacturing Plan or PMP. And the industry is reportedly looking to double production to almost $2 billion in FY24. According to the same report, when it comes to electronics manufacturing, wearables are expected to contribute $8 billion by 2026, of which $3 billion will be exports. A study by Feedback Advisory and ICEA points out that India could corner at least 10% of the global market share through exports by 2026. In 2022, the implementation of PMP on wearables boosted domestic production to 40% of the local market that year, from next to nothing the previous year. According to an IDC India report, the Indian wearables market, which grew 47% at 100 million units shipped in 2022, was led by Indian company Boat, which had an almost 24% market share. The news is also heartening on the demand side. Citing IDC India data, a recent report said that India was likely to emerge as the world's largest market for wearables by the end of 2023, even as the North American and Chinese markets were showing signs of saturation. India could account for up to 135 million units, or over 25% of the total 504 million wearable units that will be shipped globally. In a big push to the industry, the PMP brought down customs duty on most wearable components to zero in FY23. But duties will be charged at a rate between 5 to 15% between FY24 to FY26. Against this backdrop, can India finally become a global wearables powerhouse?
I am very confident that in coming years, India will be a very major player in the wearable hearable market. And my conviction comes back is supported by two major points. One, the makers here, the 75% of the market is controlled by three big brands. This means they already have the scale. Earlier, everything was coming in CBU. However, government started a PMP program, because of which almost 80% of the production is already shifted to India. I think in coming quarters, the balance 20% will also be coming to India. However, still the backward integration has not happened. So I feel in coming quarters, most of these brands will start doing some backward integration and adding more value to the product locally. Thirdly, once we are able to address the local market, definitely all of them will be looking forward to exports. And with the volume support that they are getting, that they're huge volumes, I see no reason why they should not be able to invest in design. So I see that somewhere 2024 would be a design-led manufacturing happening in India. And once that happens, the exports will start.
India has the potential to become one of the largest manufacturers of wearables. In terms of volume, I will specifically mention, because India has the favorable government policies. Even demand pull is there. Brands are also pushing a lot from themselves in terms of marketing support, in terms of launching and upgrading their portfolio. Apart from that, the price point at which these brands are launching their products, all these factors combined are paving the way for future growth.
And what are the major hurdles it will have to overcome along the way?
If we have to fight with China, in the initial 1, 2, 3 years, because industry will be already investing hugely into the backward integration and the designing, they will need certain support coming in from government by way of a PLI, so that they can go in for exports. And we have discussion with the MIT on this. MIT is open. A committee has been formed under ICA, wherein I'm also a member, and we are trying to push for it. Hopefully, the time window is very small because the elections are going to be announced, will be happening sometime next year. So we have a window till September, October before which the PLI has to come. So even though window is small, but we are bullish that looking at the export prospects, the way industry has come up and scaled up the local domestic production, government is going to come and support the industry.
What we need is the true R&D, the true innovation, the design factor, the feature innovation that should happen within the country. So I'm here not just talking about the hardware part, but I'm also talking about the software developments. That's where these premium players are playing a big role.
Indian firms will soon have the domestic market cornered, but conquering foreign shores will call for a dedicated production-linked incentive scheme and private R&D investments to compete with Apple and Samsung's value proposition in developed markets.
Moving on to markets, a buying spree of foreign institutional investors has unleashed the bulls onto Dalal Street in the past few weeks. At a time when markets trade near record high levels, will foreign investors continue to remain bullish on Indian equities? That apart, can new FPI disclosure norms by SEBI impact flows in the near term? Lovish Adarat brings you a detailed report.
After being heavy sellers throughout calendar year 2022 and the first 2 months of 2023, foreign investors took a U-turn in March 2023. Amid easing inflation and pause in interest rate hikes, foreign institutional investors have purchased equities worth 99,115 crore rupees so far in CY23, while domestic institutional investors have bought 77,419 crore rupees worth of equities. Their buying spree has helped domestic markets touch record high levels. However, a moderation could be on cards as market valuations turn expensive.
No, we expect that to moderate a little bit from the recent peak that we've seen in the months of April and May. Valuations are expensive, and we believe that in a situation of high rates with the US recession looming, we believe that the emerging market asset class will see pressure on flows. India should suffer as a result of that.
That apart, market regulator SEBI's new disclosure norms could impact close to 100 entities registered as FPIs in the near term, experts said. Under the new framework, FPIs with single group exposure of more than 50% or holdings of over 25,000 crore rupees in domestic equities will have to furnish granular details. If they do not, they could face a freeze on their holdings or be forced to trim their exposure once effective. Despite the near-term headwind, analysts believe that from a medium to long-term perspective, a slowdown in the Chinese economy would keep FII's flows into India intact. Naveen Kulkarni of Axis Securities PMS, for instance, said that though changes in global macros can cause short-term reversal, but the overall trend remains constructive. As Indian equities trade at 72% premium compared to the FTSE emerging market, this premium over the long term has been 40%. India has also traded at a premium of 110% in the past. The current premium over the emerging market index is sustainable because growth in China has remained below expectations. As regards domestic institutional investors, Kulkarni expects steady inflow of SIP money to sustain in the long term. Overall, analysts believe it will be interesting to watch out how the foreign flow trends unfold, given strong domestic macro backdrop and SEBI's new disclosure norms. Today, on July 11th, global cues, foreign flows, and crude oil prices will steer market trends.
He's making plans for an early retirement. Business Standard.
And it is not just the benchmark indices. The Indian Space Agency too is aiming for the moon. Almost 4 years after its attempts to land a spacecraft on the moon's surface failed, ISRO is ready for another shot at the moon with Chandrayaan-3. What is this mission and why do we need it? Vasudha Mukherjee explains.
Remember this emotional moment when Prime Minister Narendra Modi consoled the then ISRO chief K. Sivan after Chandrayaan-2 failed to successfully land on the moon's surface. That was September 7, 2019. Indian Space Research Organization, or ISRO, is known for taking failures in its stride. Almost 4 years on, it is ready with a fresh mission. Chandrayaan-3 is scheduled to be launched at 2:35 p.m. on 14th of July from Sriharikota. On its success, it will make India the 4th country to land spacecraft on the moon. But what exactly is Chandrayaan-3, and why is it so important for India? Chandrayaan-3 is the third installment of the Chandrayaan series and India's second attempt to achieve a soft landing on the moon's surface. It will reach a lunar orbit almost a month after its launch, and it is likely to land on the moon on August 23rd. The Chandrayaan-3 will become the world's first mission to soft land near the lunar South Pole. Earlier spacecraft have landed in the equatorial region, and polar regions of the moon have not been explored so far. The Chandrayaan-1 mission had indicated the presence of water on the lunar surface. ISRO's new chief, S. Somnath, has said the space agency has designed Chandrayaan-3 with a failure-based approach. Explaining it, he said that the space agency looked at what are the things that can go wrong, and those, he said, have been addressed. Chandrayaan-3 maintains the same mission architecture as its predecessor, while incorporating some crucial modifications. Unlike its predecessor, which comprised the Vikram lander, Pragyan rover, and an orbiter, Chandrayaan-3 will be equipped with a lander and a rover only. Chandrayaan-3 consists of an indigenous lander module and a propulsion module and a rover. The lander will have the capability to soft land at a specified lunar site and deploy the rover, which will carry out in situ chemical analysis of the lunar surface during the course of its mobility. It also incorporates lander hazard detection and avoidance cameras to assist in coordination. A laser retroreflector array has also been added to understand the dynamics of the moon system. This addition supplements the 3 payloads that were also part of the Vikram lander on Chandrayaan-2. ISRO integrated the Chandrayaan-3 spacecraft with the GSLV Mk3 rocket on July 7 to better facilitate its journey to the moon. With optimized payload configurations, improved lander capabilities, the mission is expected to address past challenges and enhance our understanding of the moon and exoplanetary research.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The Chandrayaan-3 mission cost around 615 crore rupees, a tad above the estimated 600 crore rupee mark. Well, that's all for today. Catch the next episode of The Morning Show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.